Today we are going to talk about the 5 biggest red flags to look for when analyzing a new market. What's going on, guys? I'm Joe, Director of Acquisitions and New Market Research here at Boselli Brothers Real Estate. And today we're going to talk about the 5 biggest red flags when analyzing a market to invest in. One of the hardest parts about investing in real estate is choosing where you'd like to invest your money. Whether you're planning on flipping houses, executing a buy and hold, or wholesaling, there are many different elements you need to look for to ensure that you are investing your money in an optimal place. Regardless of your strategy, here are 5 main red flags to look out for that can immediately ruin a market's viability. But before we get started, guys, if you enjoy our content, please smash that like button and hit subscribe because it helps the channel more than you think, and it will help us continue to create awesome free content like this. All right, let's jump into it. Number 5, low economic diversity. When a real estate market heavily favors or relies on a single industry or employer, it poses a potential risk for investors. Economic diversity acts as a cushion, protecting investors against industry-specific downturns so that one single company going out of business will not collapse an entire market. Without this diversification, a single economic shock can lead to things like decreased demand for housing, declining property values, and increased vacancy. A lack of economic diversity should serve as a cautionary signal, prompting further research and analysis to ensure the stability of a long-term asset. To prevent this, you should always select a market with its population evenly distributed to each industry. Websites such as bestplaces.net can provide important population data to help you make an informed decision when choosing a market. Number 4, states with unfavorable landlord regulations. Another thing you guys have to be careful about when determining where to invest your money is investing in states with strict landlord regulations. Generally speaking, these are going to be your blue states like Oregon, Massachusetts, and California that have laws in place to severely handcuff your ability as a landlord, making processes like evictions even more painful than they already are. Trust me, the last thing you want when you have a bad tenant that's not paying rent is to have to deal with that headache for another 9 to 10 months. Although it is definitely possible to invest successfully in these markets, it is essential to know the risks involved in doing so. You should always spend some time reading up on state laws that you may encounter throughout the life of your asset. Number 3 is high crime rates. Crime rates are always one of the first things that I look for when researching a new market to invest in. An area with high crime leads to decreased populations, decreased property value, and decreased rental rates, all while increasing things like vacancy. Also, there are very few quality tenants that are going to be looking for a house to live in a crime-infested neighborhood. So you are far more likely to get a tenant that's not paying their rent or not find one at all. Some things about these types of neighborhoods can be very appetizing, like low purchase prices and high cap rates. However, oftentimes for new investors, these areas come with far too much risk to be considered a smart first investment. Houses in high crime areas are far more susceptible to break-ins and theft, which can lead to much more money out of pocket for investors. If somebody off the street comes in and steals your water heater while you're trying to renovate a house, that's an extra $1,000 to $2,000 out of pocket that you didn't plan for. This type of stuff can happen more than once in a deal, which can chip away at your profit until you're in the red. The second biggest red flag on our list is increasing vacancy rates. One of the most profit-draining circumstances that you can run into on an investment property is vacancy. With your traditional investing strategies, vacancy will leave the homeowner's wallet bleeding, as they will be responsible for paying mortgage, property management fees, taxes, and insurance out of pocket without any rental income to offset it. In some cases, if vacant for too long, this can completely butcher a deal. Because of this, it is important to choose a market with low and decreasing vacancy rates. Generally, a good value to look for is 8% and decreasing over the last 5 years. Many websites will allow you to access market data for free that is broken down by year. When you're researching, if you see vacancy rates that are higher than the national average or increasing over the last 5 years, it may be a sign to invest your money elsewhere. And that brings us to our number 1 biggest red flag when determining a new market is population decline. Guys, this is the very first thing that I am looking for when analyzing a new market to invest in. Population growth is one of the biggest signs of a healthy real estate market. If the population is not growing, I'm out. Population growth is typically tied very closely to other economic factors like job growth, wage growth, and favorable taxes. In general, more people moving to the area means an increased demand for housing. In the short term, this leads to higher competition to homes and rental units, which helps to drive up home value and rental rates. Eventually, this will attract new builders and developers into your area. The developers begin to build brand new houses, which then continues to raise property values, all while helping create more jobs for contractors and continuing to boost the local economy. On the other hand, a decreasing population can be one of the biggest headwinds against the success of an investment. It is also one of the most obvious signs that you should not be investing in that area. An outflow of people from a specific market usually translates to higher vacancy rates, diminishing returns on rent, and lower home values. It also leads to much longer listing times, which can make liquidating your assets much more difficult. I can't stress this one enough, guys. It is so important to do your due diligence on population growth. You can go check out sites like bestplaces.net, worldpopulationview.com, and even get data straight from the US Census Bureau to make sure you don't invest in an area that people are running from. As usual, we will link all these sites in the description below as a treat for those of you who watched all the way to the end. And that's it for today's video, guys. Be sure to like the video if you're enjoying content like this, and leave a comment below telling us what your biggest red flag is when analyzing a new market. And as always, don't forget to subscribe to Boselli Brothers for more free real estate content, and we will see you guys in the next video. See ya. My calves are burning.
Be better looking.
Get out. Hey, Chris, you're micromanaging. Dude, you put the sexiest brother in there, you put the ugliest out.
You're thinking like poverty line.